Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined by Senior Analyst Zach Unger. We have two really important topics to discuss this week. We're going to look at the upcoming Fed rate hikes. We're also going to dive into something really interesting happening between large and small caps from a fundamental lens. First, I'm going to start talking about the upcoming Fed rate cut. This is something that's been long coming. It's been something the White House has really been pushing for. It's been a big headline in the news for most of the year, with the expectation and kind of pushing of the Fed to lower rates. And the impact that can have historically is when we start seeing rates go down, that's expected to start increasing stimulus, help the housing market, and all these other different positive effects. The one aspect to that we're going to talk about today is a little unique view on rate cuts. And the view we're going to take is how many rate cuts we get. Why that's important is what history has shown is the more rate times the Fed begins to cut rates, it actually can suggest the economy is slowing down and maybe could be in trouble. And the impact to the stock market actually is fairly bearish. However, if we just see a few rate cuts, then we start seeing actually a positive outcome to the market. If we can zoom in on the chart on your screen, what this is showing in the blue line is when we see the Fed do a cycle of rate cuts like we had in the past, then pause like they did last year, and then begin to cut again. What the difference is that blue line is when the Fed just cuts a few times. What we see is that the offensive sectors, think technology, consumer discretionary, financial sectors like that, begin to do really well relative to defensive sectors, things like consumer staples, healthcare, utilities. However, if the Fed begins to cut a lot of times, and they keep cutting and cutting and cutting, trying to provide more stimulus, stoke the economic fire, so to speak, then we start to see the opposite happen. We start to see that the economy is really showing signs of stress, and we begin to see those offensive sectors begin to underperform the defensive sectors, which historically is not a positive sign for the overall stock market. So as we go into a week where we're expecting the Fed to cut rates and start looking at the guidance for what they're expecting to do going forward, what we really want to be honed into is the number of cuts they are anticipating on making. And obviously that number will change, but if they start anticipating having a lot more cuts, then that could be a signal that the economy may be under more pressure than the data suggests right now. However, if they say they're just going to cut once, maybe one more time, then that could suggest the Fed believes the economy is on good footing and should be a positive catalyst for the stock market in the long term. So that's what we're going to be looking at when we get the next Fed results. Now I'm going to turn over to Zach, who's going to look at some of the fundamental data for the market.
Yeah, we'll continue the rates cut decision as it relates to earnings this time. You'll see a chart on your screen here that shows the earnings of large caps, the S&P 500 in red there, and the earnings of small caps, the Russell 2000 in blue. In the midst of a bull market, it's been somewhat surprising to see small cap earnings regress quite significantly since 2022. Part of that is the fact that rates have been high from the Fed. As Andrew mentioned, we're going into a season where we're expecting the Federal Reserve to begin cutting rates. That can be beneficial, particularly for small cap companies, because they tend to lean heavier on borrowing in order to fund their growth efforts. So you can see there's been a small tick up there. The blue line at the bottom as those two have diverged. There's been a small tick up. Maybe in anticipation of some rate cuts coming through, maybe some of these small caps being able to access a little bit more growth capital to begin growing and boosting earnings. The amount to which the Fed cuts rates and how long that lasts may provide a little bit of a boost to small caps to hopefully climb back to and above those 2022 levels. So that's something we'll be keeping an eye on as the Fed makes its decision, not just this week, but moving forward. What kind of impact becoming more expansionary as it relates to monetary policy could have on the small cap market.
Thanks, Zach. If you've been watching the Market Carver for several weeks, you'll know we've been talking about interest rates for a little while. While we know that's probably not the most popular topic in the news, we do realize the significance and the importance of what interest rate changes have, not only on the bond market, but on the stock market, as well as the economy, as Zach alluded to the sensitivity for some smaller caps type stocks and companies even in the private market as well. So we'll continue to monitor this, making changes and adjustments as we see fit to the portfolios. If you have any questions, we encourage you to reach out, either the phone number on your screen, the website URL on your screen, or the QR code. As always, thank you so much for watching this week's Market Carver. We'll see you next week.